Fed delays interest rate cuts, expert analysis. The Federal Reserve just put the brakes on cheaper borrowing, defying the president and leaving millions of Americans asking a simple question. Why? In a move that has stirred up Washington and Wall Street, the U.S. Central Bank announced its decision to keep interest rates steady, holding them within the 4.25% to 4.5% range. This decision comes amid significant pressure from the White House to slash rates, a move President Donald Trump has vocally advocated for. So what's really going on behind the closed doors of the Federal Reserve? To get a clearer picture, we turn to an expert. Thomas Aiello, the Senior Director of Government Affairs for the National Taxpayers Union, expressed his own surprise at the Fed's hesitation, suggesting that a rate cut was not only warranted, but overdue. But here's where it gets controversial. Aiello proposes that this decision might be less about pure economics and more about a political power play. He suggests the Federal Reserve is flexing its muscles to demonstrate its independence from the Trump administration. Even a modest cut of 25 to 50 basis points, which would bring the rate down to around 4%, is hardly going to trigger the kind of runaway inflation we saw under the Biden administration, Aiello explained. My interpretation is that the Fed felt a compelling need to assert its autonomy. By resisting the president's public demands for a rate cut, they're sending a clear message that they have resolve and won't be swayed by political pressure. Of course, the Fed has its own stated economic concerns, primarily the fear that ongoing tariffs could eventually push prices higher for everyone, a phenomenon known as inflation. Yet, Aiello argues that the immediate benefits of a rate cut would far outweigh this potential risk. A cut, he points out, would be a direct boost for everyday consumers and the nation's finances. Think about what lower rates mean in practical terms, Aiello elaborated. It would reduce the cost of borrowing for major life purchases, like getting a mortgage for a new home or financing a construction project. And this is the part most people miss. It would also lower the interest payments on our massive national debt. Essentially, we'd be able to finance our country's obligations at a more affordable rate, with some analysts predicting a cut in September. The pressing question remains, why wait another 2 months? The answer may lie in the confusing economic data. On the surface, the economy looks strong, with gross domestic product, GDP, surging unexpectedly in the second quarter. This happened even as President Trump was finalizing tariff deals ahead of the August 1st deadline. However, Aiello cautions that if you look beneath the hood of that shiny GDP number, you'll find some worrying signs, another key reason for the Fed's cautious stance. When you dissect the report, you see a decline in domestic investment, which means businesses are spending less on new equipment and buildings, he noted. You also see that small businesses are holding fewer goods in their warehouses, a sign they're worried about future sales. On top of that, consumer spending saw its weakest growth since the middle of 2022. Ultimately, the Federal Reserve operates on a longer timeline. The Fed doesn't make monumental decisions based on a single month's data, Aiello reminds us. He believes they're waiting to see at least one more comprehensive jobs report and another inflation reading before committing to a new direction. Speaking of the jobs report, which is due out this Friday, Aiello remains optimistic. He anticipates the creation of around 100,000 new jobs. Job growth has been surprisingly resilient these past few months, he said. With the certainty provided by recent tax cuts and new trade agreements, I'm hopeful we'll Fed holds rates steady amid Trump pressure, internal divisions. Key takeaways. The Federal Reserve's latest decision to hold interest rates steady has sparked both relief and controversy as the central bank walks a tightrope between economic caution and political pressure. But here's where it gets controversial. This move, keeping rates unchanged for the fifth consecutive meeting, has drawn sharp criticism from President Donald Trump and his allies, who are demanding lower borrowing costs to boost the economy. And this is the part most people miss. The Fed's decision wasn't unanimous. For the first time since 1993, two governors, Christopher Waller and Michelle Bowman, voted against the majority, advocating for a rate cut instead. Their dissent highlights the growing tension within the Fed as it navigates an uncertain economic landscape shaped by Trump's trade policies and a stubbornly strong labor market. The central bank's benchmark rate remains at 4.25% for 4.5%. A level it has held since December, yet the pressure is mounting. Trump and his supporters have repeatedly criticized the Fed's wait-and-see approach, accusing it of stifling economic growth. Fed Chair Jerome Powell, however, argues that the early days of the president's tariffs are still too unpredictable to justify immediate action. There are many uncertainties left to resolve, Powell emphasized during a post-meeting press conference. But will patience pay off? Or is the Fed risking a slowdown by holding rates too long? The dissenting votes themselves have become a focal point of debate. While such disagreements are rare, Powell downplayed the split, calling it a good meeting where officials aired their views. Waller and Bowman, however, are expected to clarify their reasoning soon, potentially shedding light on whether the Fed is too cautious or too slow to act. Market expectations, meanwhile, suggest a rate cut is likely this year, possibly as early as September. But Powell stops short of confirming any timeline, stressing that we have made no decisions about September. The question remains, how much evidence does the Fed need before it pivots from restraint to action? The labor market, a long-standing pillar of U.S. economic strength, is now under scrutiny. While Powell insists the job market remains resilient, he also acknowledged a slowing of job creation and downside risks. Critics like San Francisco Fed President Mary Daly argue that inaction could lead to further deterioration. You can't wait forever, Daly warned earlier this month. Yet the Fed's dual mandate, controlling inflation and safeguarding employment, leaves officials in a bind. How do they balance these priorities when the path forward is anything but clear? Then there's the housing market, where high rates have stifled demand even as supply remains scarce. Trump has shifted his focus from debt concerns to home affordability, demanding rate cuts to help buyers and refinancers. But as Powell noted, there are other things going on in housing, like a long-term shortage of homes that no rate cut can fix. And history shows the Fed's rate decisions don't always translate to lower mortgage rates, complicating the president's argument. Amid all this, the Fed's headquarters renovation has become an unlikely flashpoint in the Trump-Powell feud. The $2.5 billion project, criticized as a waste, has drawn Trump's ire, and even a public spat during a recent site visit. Yet Powell insists the priority is completing the construction. And Trump has recently softened his tone, saying he'll greatly miss Powell when his term ends in 2026. Is this a sign of thawing relations? Or just political theater before the next round of clashes? The economic data adds another layer of complexity. While Q2 GDP growth of 3% exceeded expectations, the numbers mask underlying fragility. A sharp rebound from Q1's 0.5% contraction was driven by surging imports, likely a temporary response to looming tariffs. Real final sales to private purchasers, a key demand indicator, slowed to 1.2% in Q2 from 1.9% in Q1. Powell acknowledged the moderation in growth, but the Fed's own policy statement hinted at lingering risks. With net exports still volatile and housing markets struggling, the central bank faces a dilemma. Cut rates now and risk inflation, or wait and risk a deeper slowdown. So where does this leave us? The Fed is caught between political pressure, economic uncertainty, and the weight of its own mandate. As Powell puts it, these are the early days of a complex economic chapter. But here's the real question. Should the Fed prioritize short-term political demands or long-term economic stability? Do you agree with the Fed's cautious approach, or is it time for a bolder move? Share your thoughts in the comments, because the debate is far from over.